So let's start with the sea change. That was the big headline from your report. It's how you kicked off your memo. You said 53 years in your investing career, there have been 3 sea changes, and we are in one of them. What does that mean?
Well, a sea change is a major transformation of the environment, a complete change in attitudes, etc. And I suspect that we may be at the beginning of one.
Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, let's look at a short summary from the latest memo from the legendary super investor Howard Marks. Mr. Marks is co-founder and co-chairman of Oaktree Capital Management, the largest investor in distressed securities worldwide. He's also a best-selling author of investing and stock market related books, some of which we have summarized on this channel. His memos are extremely popular in the investing community, with none other than Warren Buffett stating that he always looks forward to these memos. The December 2022 memo is titled Sea Change. The memo hints at a third sea change that Mr. Marks says has arrived. Sea change means a complete transformation, a radical change of direction in attitude and goals. In this video, let's take a look at the top 5 takeaways from this memo. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos on these memos. Let's continue. Mr. Marks starts the memo by saying that in my 53 years in the investment world, I have seen a number of economic cycles, pendulum swings, manias and panics, bubbles and crashes, but I remember only 2 real sea changes. I think we may be in the midst of a third one. Let's look at the top takeaways. Takeaway 1. Sea change 1. Looking at high-yield bonds with risk versus return perspective. When Mr. Marks started his career, a security with a rating of single B was described by Moody's as failing to possess the characteristics of a desirable investment. Non-investment grade bonds, those rated double B and below, were off limits to fiduciaries, since proper financial behavior mandated the avoidance of risk. For this reason, what soon became known as high-yield bonds couldn't be sold as new issues. But in the mid-1970s, Michael Milken and a few others had the idea that it should be possible to issue now non-investment grade bonds and to invest in them prudently if the bonds offered enough interest to compensate for the risk of default. In 1978, I started investing in these securities, the bonds of perhaps America's riskiest public companies, and I was making money steadily and safely. In other words, whereas prudent bond investing had previously consisted of buying only presumably safe investment grade bonds, investment managers could now prudently buy bonds of almost any quality as long as they were adequately compensated for the attendant risk. The US high-yield bond universe amounted to about $2 billion when I first got involved, and today it stands at roughly $1.2 trillion. However, the most important aspect of this change didn't relate to high-yield bonds or to private equity, but rather to the adoption of a new investor mentality. Now, risk wasn't necessarily avoided, but rather considered relative to the return, and hopefully born intelligently. This new risk-return mindset was critical in the development of many new types of investment, such as distressed debt, mortgage-backed securities, structured credit, and private lending. It's no exaggeration to say today's investment world bears almost no resemblance to that of 50 years ago. Young people joining the industry today would likely be shocked to learn that back then, investors didn't think in risk and return terms. Now, that's all we do, ergo a sea change. Takeaway 2. Sea change 2. Low declining interest rate environment. At roughly the same time, big changes were underway in the macroeconomic world. It all started with the OPEC oil embargo of 1973 and 74, which caused the price of a barrel of oil to jump from roughly $24 to almost $65 in less than a year. This spike raised the cost of many goods and ignited rapid inflation. Because the US private sector in the 1970s was much more unionized than it is now, and many collective bargaining agreements contained automatic cost of living adjustments, rising inflation triggered wage increases, which exacerbated inflation and led to yet more wage increases. This seemingly unstoppable upward spiral kindled strong inflationary expectations, which in many cases became self-fulfilling, as is their nature. The year-over increase in the Consumer Price Index, which was 3% in 1972, rose to 11% by 1974, receded to the range of about 6 to 9% for 4 years, and then rebounded to 11% in 1979, and 13.5% in 1980. There was great despair, as no relief was forthcoming from inflation-fighting tools. It took the appointment of Paul Volcker as Fed chairman in 1979 and the determination he showed in raising the Fed funds rate to 20% in 1980 to get inflation under control and extinguish inflationary psychology. As a result, inflation was back down to roughly 3% by the end of 1983. Volcker's success in bringing inflation under control allowed the Fed to reduce the Fed funds rate to the high single digits and keep it there over the rest of 1980s before dropping into the mid-single digits in the 1990s. His actions ushered in a declining interest rate environment that prevailed for 4 decades. Mr. Marks considers this the second sea change he has seen in his career. The long-term decline in interest rates began just a few years after the advent of risk-return thinking, and he views the combination of the two as having given rise to A. the rebirth of optimism among investors, B. the pursuit of profit through aggressive investment vehicles, and C. an incredible 4 decades for the stock market. What a period! There can be no greater financial investment career luck than to have participated in it. While there can be many reasons for this spectacular return, but Mr. Marks believes that the 40 years of declining interest rates probably played the greatest role of all. Takeaway 3. Impact of declining interest rates. Mr. Mark goes on to share a masterclass in what happens when, or what are the effects of declining interest rates. First, they accelerate the growth of the economy by making it cheaper for consumers to buy on credit and for companies to invest in facilities, equipment, and inventory. They provide a subsidy to borrowers at the expense of lenders and savers. They reduce business costs of capital and thus increase their profitability. They increase the fair value of assets. The theoretical value of an asset is defined as the discounted present value of its future cash flows. The lower the discount rate, the higher the present value. Thus, as interest rates fall, valuation parameters such as PE ratios and enterprise values rise, and cap rates on real estates decline. They reduce the prospective returns investors demand from investments they're considering, thereby increasing the prices they'll pay. This can be seen most directly in the bond market. Everyone knows it's rates down, prices up, but it works throughout the investment world. By lifting asset prices, they create a wealth effect that makes people feel richer and thus more willing to spend. Finally, by simultaneously increasing asset values and reducing borrowing costs, they produce a bonanza for those who buy assets using leverage. Mr. Marks shares a simple example or analogy to convey his view of the effect of prolonged decline in interest rates. At some airports, there is a moving walkway, and standing on it makes life easier for the weary traveler. But if rather than stand still on it, you walk at your normal pace, you move ahead rapidly. That's because your rate of travel over the ground is the sum of the speed at which you're walking plus the speed at which the walkway is moving. That's what he thinks happened to the investor over the last 40 years. They enjoyed the growth of the economy and the companies they invested in, as well as the resulting increase in the value of their ownership stakes. But in addition, they were on a moving walkway, carried along by the declining interest rates. The results have been great, but I doubt many people fully understand where they came from. It seems to him that a significant portion of all the money investors made over this period resulted from the tailwind generated by the massive drop in interest rates. He considers it nearly impossible to overstate the influence of declining interest rates over the last 4 decades. Takeaway 4. That was then, this is now. Of course, all of the above flipped in the last year or so. Most importantly, inflation began to rear its head in the early 2021 when our emergence from isolation permitted too much money, savings amassed by the people shut in at home, including distributions from the massive COVID-19 relief programs, to chase too few goods and services. Because the Fed deemed the inflation transitory, it continued its policies of low interest rates and quantitative easing, keeping money loose. These policies further stimulated demand, especially for homes, at a time when it didn't need stimulating. Inflation worsened as 2021 wore on, and late in the year, the Fed acknowledged that it wasn't likely to be short-lived. Thus, the Fed started reducing its purchase of bonds in November and began raising interest rates in March 2022, kicking off one of the quickest rate hiking cycles on record. The stock market, which had ignored inflation and rising interest rates for most of 2021, began to fall around year-end. From there, events followed a predictable course. While events in the real world fluctuate between pretty good and not so good, investor sentiment often careens from flawless to hopeless, as events that were previously viewed as benign come to be interpreted as catastrophic. Higher interest rates led to higher demanded returns. The stocks that had seemed fairly valued when interest rates were minimal fell to lower PE ratios that were commensurate with higher rates. Likewise, the massive increase in interest rates had its usual depressing effect on bond prices. Falling stock and bond prices caused FOMO to dry up and fear of loss to replace it. The market's decline gathered steam, and the things that had done best in 2020 and 2021, tech, Software, SPACs, cryptocurrencies now did the worst. Exogenous events that have the ability to undercut the market's mood, especially in tougher times, and in 2022, the biggest such event was Russia's invasion of Ukraine. The Ukraine conflict reduced supplies of grain and oil and gas, adding to inflationary pressures. Since the tighter monetary policies were designed to slow the economy, investors focused on the difficulty the Fed would likely have achieving a soft landing, and thus a strong likelihood of a recession. The anticipated effect of that recession on earnings dampened investors' spirit, thus the fall of S&P 500 over the first 9 months of 2022 rivaled the greatest full-year declines of the last century. The expectation of a recession also increased the fear of rising debt defaults. New security issuance became difficult. Having committed to fund buyouts in a lower interest rate environment, banks found themselves with many billions of dollars of hung bridge loans unsaleable at par. These loans have saddled the banks with big losses. These hung loans forced banks to reduce the amounts they could commit to new deals, making it harder for buyers to finance acquisitions. The progression of events described above caused pessimism to take over from optimism. The market, characterized by easy money and upbeat borrowers and asset owners, disappeared. Now lenders and buyers held better cards. According to Mr. Marks, we are witnessing a complete reversal of the conditions that prevailed in 2021 and late 2020 and throughout the 2009 to 2019 period, and for much of the last 40 years. Takeaway 5. Interest rates likely to remain higher for longer. According to Mr. Marks, inflation and interest rates are highly likely to remain the dominant consideration influencing the investment environment for the next several years. While history shows that no one can predict inflation, it seems likely to remain higher than what we became used to after the global financial crisis, at least for a while. The course of interest rates will largely be determined by the Fed's progress in bringing inflation under control. As per Mr. Marks, the buyers who have driven the S&P 500's recent 10% rally from the October low have been motivated by their beliefs that A. Inflation is easing, B. The Fed will soon pivot from restrictive policy back towards stimulative, and C. Interest rates will return to the lower levels, D. A recession will be averted or it will be modest and brief, and E. The economy and markets will return to the heydays. In contrast, here's what Mr. Marks thinks. The underlying causes for today's inflation will probably abate as relief-swollen savings are spent and as supply catches up with the demand. While some recent inflation readings have been encouraging in this regard, the labor market is still very tight, wages are rising, and the economy is growing strongly. Before declaring victory on inflation, the Fed will need to be convinced not only that inflation has settled near the 2% target, but also that the inflationary psychology has been extinguished. Thus, while the Fed appears likely to slow the pace of its interest rate increases, it's unlikely to return to stimulative policies anytime soon. The Fed has to maintain credibility or regain it after having claimed for too long that inflation was transitory. It can't appear to be inconstant by becoming stimulative too soon after having turned restrictive. These are the reasons why he believes that the base interest rate over the next several years is more likely to average between 2 to 4%, rather than between 0 to 2%. Of course, there are counter-arguments, but for him, the bottom line is that highly stimulative rates are likely not in the cards for the next several years, barring a serious recession from which we need rescuing, and that would have ramifications of its own. What we do know is that inflation and interest rates are higher today than they have been for the last 40 years. Regardless, he thinks things will generally be less rosy in the years immediately ahead. A recession in the next 12 to 18 months appears to be a foregone conclusion among economists and investors. That recession is likely to coincide with deterioration of corporate earnings and investor psychology. Credit market conditions for new financing seems unlikely to soon become as accommodative as they were in the recent years. No one can foretell how high the debt default rate will rise or how long it will stay there. It's worth noting in this context that the annual default rate on high-yield bonds averaged 3% from 1978 to 2009, but at unusually low 2% under the just right conditions that prevailed for the decade 2010 to 2019. In fact, there were only 1 year in that decade in which defaults reached the historical average. Lastly, there is a forecast he's confident of. Interest rates aren't about to decline by another 2,000 basis points or 2% from here. As Mr. Marks has said many times, we never know where we are going, but we ought to know where we are. The bottom line is that in many ways, conditions at this moment are overwhelmingly different from and mostly less favorable than those of the post-global financial crisis climate. These changes may be long-lasting or they may veer off over time, but in his view, we are unlikely to quickly see the same optimism and ease that marked the post-global financial crisis period. We have gone from the low-return world of 2010 to 2021 to full-return world, and it may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return target. Lenders and bargain hunters face much better prospects in this changed environment than they did from 2010 to 2021. And importantly, if you grant that the environment is and may continue to be very different from what it was over the last 30 years and most of the last 40 years, it should follow that the investment strategies that worked best over those periods may not be the ones that outperform in the years ahead. That's the sea change he's talking about. For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive the follow-up videos on Howard Marks memos. Thanks for watching.